Hello and welcome to Market Insights, where we break down everything you need to know about the world of Forex trading. Today we're diving into a phenomenon that catches traders' attention every weekend, Forex market gaps. We'll explore the causes that these gaps, why they're so common over the weekend, and how traders can prepare and even take advantage of them. Whether you're new to trading or an experienced Forex enthusiast, understanding market gaps can add a unique dimension to your trading strategy. Let's start with the basics. What exactly is a Forex market gap? Simply put, a gap in the Forex market occurs when there is a sudden shift in price between the close of one trading session and the open of the next, leaving a gap on the price chart. This means that instead of price moving smoothly from one point to another, there's a jump or drop that skips a price range entirely. In the Forex market, this is often seen as a jump in the price when the market reopens after the weekend. In the stock market, gaps happen all the time, usually overnight, but in Forex, where trading is 24 hours a day from Monday to Friday, gaps are most common over the weekend. The reason? It's all about liquidity and market activity. Now, why do these happen? Why do these gaps happen specifically over the weekend? Forex markets, many may technically close on Friday and reopen on Sunday, but that doesn't mean the world stop turning. News, geopolitical events, and economic development continue to unfold over the weekend. A major political announcement, a sudden economic crisis, or an unexpected event can all cause investors to adjust their positions as soon as the market reopens, resulting in a price gap. For instance, imagine a country announces a surprising election result or central bank decision on a Saturday. Traders and institutions are quick to react to this news when the market opens, resulting in a price jump or drop. These weekend's events trigger a frenzy of buying or selling as soon as trading resumes, causing gaps that traders either want to avoid or capitalize on. So how do traders approach weekend gaps? It largely depends on their trading styles and risk tolerance. Let's break down a few approaches. Gap trading strategy. Some traders use what's known as a gap trading strategy, which assumes that the price will fill the gap after an initial jump. In other words, if a currency pair gaps up when the market opens, they may expect the price to eventually fall back to the previous close level. This approach, known as gap filling, is based on the idea that the price often returns to a more balanced level after an initial overreaction. Here's how it works. A traders wait for a gap in price on Sunday's open, and once the initial price spike or dip settles, they look for opportunity to trade in the opposition direction of the gap, aiming for a fill. However, this strategy can be tricky because there's no guarantee that the price will always return to its previous level. Avoiding the gap. There are traders who prefer to avoid trading around market opening altogether. For these traders, gaps are unpredictable and can be risky. They may choose to close their position on Friday to avoid exposure to any potential gaps. This approach is especially common for risk-averse traders and those who simply don't want to be exposed to unexpected weekend events. Position adjustment and hedging. Some traders prefer to keep their positions open over the weekend but adjust them to manage potential gaps. For instance, a trader might hedge their position by entering a small trade in the opposite direction to offset any potential losses caused by a gap. Hedging allows them to remain in the market without being fully exposed to weekend risk, but it does require more advanced knowledge and a solid understanding of market conditions. So, are market gaps always something to be feared? Not necessarily. For many traders, these gaps present unique opportunities because they are driven by sudden news or shifts in market sentiments. Gaps can offer quick pips if you're on the right side of the price action. If you have a good grasp of market fundamentals, weekend gaps can provide a valuable opportunity to capitalize on unanticipated shifts. For instance, if you've been following a country economy situation and are confident about an upcoming decisions that could affect its currency, you might anticipate a gap. For traders willing to take on the risk, this can be a way to benefit from fundamental analysis as long as they have a clear risk management plan. But let's talk about risk management because that's key with any trading strategy, especially this with gaps. The forex market can be unpredictable and gaps add an extra layer of uncertainty. Here are a few tips on managing risk around weekend gaps. Use stop loss wisely. A gap can skip your stop loss entirely if the market opens below or above your stop loss. To prevent excessive losses, some traders set a wider stop loss before the weekend, giving the price room to move while still limiting risk. But here's the problem. During the gap in the weekend, some brokers will execute your stop loss where the market opens. So let's say there's 1,000 pip gap and your stop loss is for 10 pip. You will lose 1,000 pip. This is what happened before for one of my traders. Adjust position size. Since gaps can create sudden moves in price, it's wise to reduce position size going into the weekend if you plan on holding positions. Smaller positions limit your exposure and help manage potential gap better. Stay updated on market news. Staying informed on current events is essential. Follow major news sources and economic calendars to stay aware of any potential weekend's news that could impact the market. Finally, let's look at currency pairs and how they're affected differently by weekend gaps. Not all pairs are equally prone to gaps. Major pairs like EURUSD or GBP/USD tend to be less volatile during weekend openings compared to exotic pairs or currency pairs from emerging markets. Exotic pairs are more susceptible to larger gaps due to lower liquidity and increased vulnerability to unexpected events. If you're newer to trading, it's generally safe to focus on major pairs where weekends gaps might be more predictable and manageable. On the other hand, experienced traders might explore exotic pairs for larger gaps, although this comes with greater risk. So, to sum up today's episode, weekend gaps are a fascinating aspect of forex markets. They reflect the global 24/7 nature of forex trading, where news and events don't stop just because the market closes. While they can pose risk, they also offer opportunities for those willing to dive deeper, prepare, and trade with caution. If you're a beginner, start by observing these gaps and understanding how they affect the pair you trade. And for the more seasoned traders out there, weekend gaps can be powerful additions to your trading strategy as long as you approach them with a clear plan and solid risk management. Thank you for joining me on this episode of Market Insight. If you found this episode helpful, be sure to subscribe, share, and leave us a review. Until next time, keep learning, stay informed, and trade smartly. Catch you in the next episode.